Now, my main focus point today is about the broader US economy and the fact that there's a bit of a paradox. We have very much a K-shaped economy. Some are doing very well, mainly those that own some type of assets, usually homes, stocks, even cryptocurrency, and they're doing well. If you don't own a lot of that, well, then you are likely struggling to some degree. And that is really a story that our economy is really propped up by a lot of these assets. And official data continues to show that overall the economy is doing quite well, right? The top line numbers, you have relatively low unemployment. Inflation has come down, but still, elevated from where we were pre-pandemic, hanging around the 3% level. But not where we were, high single digits just a couple of years ago. And what the data is saying is that if you make over $150,000 roughly, you're doing most of the spending that's driving the broader economy. But the fact that most of that spending is fueled by the wealth effect of the equity in their homes and stock market returns and cryptocurrency returns, all of that is vulnerable, right? You see that today or the past couple weeks, how much of the sell-off in not just equities, but cryptocurrency could suddenly change the sentiment. You're already seeing sentiment wane a bit over the past couple of months. And if that turns, and thus the sentiment from the wealthy turn, that will absolutely spin us into a recession. Because if you make less than $73,000 per year, you're kind of already in a recession, despite the fact that most of them have jobs, but they don't have a lot of those assets that have appreciated. And you see this in the delinquency rates. Overall, consumer debt delinquencies are the highest level in nearly 5 years. Now, one caveat there is that this is from very low levels. Talking about the pandemic and massive amounts of stimulus that kind of spun everybody out of much financial stress because they were getting checks from the government. There were forbearances on mortgages and student loans, etc., and it just made carrying day-to-day life a lot easier from a financial perspective when you don't have the weight of those two types of debts really pushing on the lower income consumers. But now the moratorium on a lot of that is up and people are having to go back to pay those bills. And the share of credit card accounts showing delinquencies of at least 90 days or longer is now over 11%. That's the highest level since 2011. Okay, so you're starting to, in some instances, get above pre-pandemic norms. And that's where I think the worry really lies. Okay, so it's the credit card debt. And the share of active credit cards making just the minimum payment up to the 12-year high, at a 12-year high. Okay. And pre-pandemic, the growth in spending was fairly well distributed, but since the pandemic, because of the equity in people's homes, all these asset value increases due to stimulus, it is really driven that K-shaped economy. And you can see that in FICO scores as well. The percentage of credit scores now 750 or higher is at a record high. And those credit scores 600 or lower is creeping up after many years of decline. So a lot of people that are getting checks and once again forbearances, that weren't smart with their money or didn't have enough income, they're the ones that are sliding once again into poor credit. Now, there's no sign that there's an imminent problem here, but clearly our economy and the spending around the economy is predicated on equity valuations, cryptocurrency valuations staying relatively elevated. And I think that's the biggest worry here, is that it's so driven by those factors. And that's why, while the GDP now figure is negative, I think that's mostly export driven or import driven, excuse me. But you certainly could see if you get a larger equity pullback, and that's why I think Trump is playing a fire here. Is if there's too much volatility, it's going to be hard to spin us back out of this downturn.